As we speak, Netflix is trading live on the NASDAQ at $1,098.46, which is up about 0.5% on the day, or $5.50. It has been oscillating in a tight range today between roughly $1,084 and $1,100. But the real story today isn't this modest green candle. The far more telling detail is what has been happening quietly in the background, in the SEC filings. While the price ticks up, the C-suite is selling. Just 2 days ago, on November 4th, co-CEO Gregory Peters sold over $2 million worth of stock. The day before that, CFO Spencer Newman sold over $760,000 worth. This isn't a panic, but it's a significant signal from the very people who have the most insight into the company's operations. It suggests that, in their professional opinion, the stock's valuation at these levels might be a good time to take some profits off the table. This action creates a fascinating tension because it runs counter to the story most of the market is telling itself. The common belief about Netflix is one of total, unassailable dominance. The narrative is that the streaming wars are over and Netflix won. They successfully cracked down on password sharing, converting millions of users into paying customers. They launched their ad-supported tier, which is now the default choice for over half of all new signups in those markets. The expectation is that this ad business is a new, high-margin rocket ship that will propel earnings into the stratosphere, justifying the stock's massive run. But this expectation, the story of flawless victory, is dangerously simple. The reality is that Netflix has just traded one difficult business model for another, far more complex one. It has solved its subscriber growth problem for now, only to find itself in a brutal knife-fight competition for advertising budgets against the most powerful companies on Earth, like Google and Meta. And as the insider sales suggest, the path from here is not as clear or as guaranteed as the climbing stock price would have you believe.